Not three, but four halts today in GME today, absolutely skyrocketing volatility to the upside early in the day just to see most of the gains depreciated. But we're going to talk about why fragility in the crypto market, more specifically, could be the end of these GME shorts. For the shorts to continue to expand their balance sheet, they need to continuously take on these loans in these underground agreements through these bilateral parties. And to do that, you need everybody to agree to the system. What we see when there's fragility in their system is people need to hold on to what they have and they don't want to do business with counterparty risk. The only way a bank can go bust is counterparty risk and, well, more specifically, perceived counterparty risk. So when there's times of fragility, everybody wants to have they want to artificially prop up their balance sheet and make it look as pristine as possible, just so all other players collectively agree to the game. And when there's fragility, people need to hold on to tight collateral. I mean, we can see this in countless ways. If you look
RRP's hitting
are
1.9.
the in continuous demand for extremely short dated treasuries. We see repo fails spiking, showing fragility. There's the twos, tens inverting. We see crypto really starting to fall with these stable coins. And because of that, that is potentially going to prevent the ever expanding balance sheets from expanding because people are not going to want to do business with riskier and riskier clients. The reason this would prevent the short from getting shorter is because no one's going to be able to do business with them. And I think we could have saw some sparks of that today. I know there's a lot of FTD exposure, and there's more that's going to be going on within the next few months. And I think if there is going to be an end game, we will see it in the short near future.
I would just like to say, Josh, a big tip of the hat to PiFi, who again pretty much I think called this to the day in terms of EFT exposure, particularly if FTDs coming in or arising from ETF fails, at least as I poorly understand it. So I think that's interesting. Trading wise, Josh, what I've done is I've got a few. I think I wrote one covered call today, somewhat near the top. But really, what I've got going on is that if you've been following PiFi streams, you're probably going to see some positive price action over the next few days, and it might even peak as we get into the closeout of the option expirations for May. But then again, per PiFi, expect it to fall back down towards the end of the month, particularly if the market continues to sell off at large. So what my plan is that if we do see a run up, I hope that the limit orders that I've set to sell covered calls will fill as we get higher and higher and higher. And likewise, I also have a few limit orders set to buy protective puts, at the high point. So if we do go back down, I will then like to, close out my covered calls, buy them back at a gain, and then see what I do with the puts, but probably just sell them off because ultimately I want to buy more shares with more cash that I can make off the volatility. And I think that's the name of the game for those who feel comfortable enough learning how to trade volatility and make it work to their advantage.
Yeah, the greatest part about GME is its volatility to the upside and to the downside. It provides astronomically incredible opportunities for people willing to learn and capitalize on everything that goes on. Because, like Justin was just alluding to, PiFi called this to the day. The reason is because there's so much evidence that allows you to accurately predict the price movements with relative accuracy. I mean, this is one of the only stocks in history where you can do that. And because
Yep.
of that, there's massive opportunities. I mean, if you were looking at our Twitter, I was actually loading up on calls early yesterday, Wednesday, and this morning, and it worked out really, really well.
Yeah, if nothing else, the implied volatility spike, getting that bump, like, oh yeah, there's some sweet gains to be made. And I guess just gets back into this one of these things too, where it's like, by all means, this doesn't necessarily preclude MOAs from happening, but these are steps you can do so that when MOAs does eventually happen, you are better positioned to better capitalize on MOAs in the interim. And the best part is that if you're just trying to tread water between now and then, it's a great way to do it. Now, to be clear, you need to know what you're doing, right? You just don't want to stumble into it. But again, is this not true of everything in life, Josh? Educate yourself. There's no reason why you shouldn't try to educate yourself. And if after, learning more about it, it's still not for you, hey, at least you looked into it. No shame in that.
Yeah, people were calling us butters when we were talking about direct registering your shares and why we think you should have a diversified amount across different boards because we're so option bullish because options are betting on volatility essentially, and because GME is basically a volatility play, there's so many opportunities in the option markets and people are so scared of them for not a whole lot of reason because that's where the real massive interim gains are made. So, Justin, this is pretty much all that's going on in GME land. Do you have any final thoughts?
Nope. Like I said, I think if you time this right, you might see a spike as we go into the end of this week. Particularly, there's delta hedging that's to come from the option chain being bought back up with calls exceeding puts. That's going to work in our favor. Whatever happens with OPEX would be a tailwind.
We actually did see selling of puts early in today instead of buying puts. So that was very, very bullish. And
Yeah.
I have not yet seen the entire option change, but I know that there were some massive orders of people actually selling puts, which means they're buying the right to own GME stock. GME gets dangerous for the shorts when GME starts to trade below the 90s into the 80s and even up to 70s. The
Oh,
buy
yeah.
orders on the past 2 days have been like just ridiculous. It was like,
Yeah, like 90, 80%. Like,
yeah, way more than that. I mean, it was like 15 to 1 buy orders because people are just like, hey, it's on massive discount. So the shorts are going to have a very tough decision because they have to keep it range bound. There's really no way that they can let it get down this low because retail just starts buying hand and fist. That really brings the point. Well, if this is what's happening when it gets into the 70s, what happens if they do a shared dividend split and it gets down into the teens, into the single digits potentially? Because that is when retail would really start
oh, yeah.
purchases at a humongous rate.
And the other thing is, I think Pi said he's got a DD coming out this week, and assuming he's able to get it out, where it started off as like a tinfoil hat idea, and maybe it still is in the realm of tinfoil hat, but it's nothing else, just a fun thought experiment. What if they were to do a reverse split? Example, you have 2 shares right now, and then after the reverse split, you have 1 share. So it's like turning like 2 $50 bills into one $100 bill. You still have the same amount, it's just you now have 1 bill instead of 2. If you wanted to blow up a volatility position, Josh, that would be one way to do it. And I think if I'm getting
the reasoning behind it, because if
Yeah.
you did a reverse split, it would increase volatility a lot because there's less shares that are
yeah, force it, and then it becomes more and more out of range. And again, like I'm really talking.
What Justin's talking about is you do that reverse split, contracting the amount of shares, increasing volatility, and then do the actual split, giving everyone more shares. I mean, that would be pretty brilliant if something like
Yeah.
that would play out.
And in the interim, if let's say that leads to a Volga-Vanna squeeze, which in turn leads to delta hedging, which in turn leads to a gamma squeeze, which in turn blows up, let's say O to C, as Josh likes to talk about, I like to talk about these exotic transactions that used to go, on a bilateral agreement. If those start blowing up, then you actually have, the sequence of events that can lead to perhaps a very interesting outcome. But again, until it has happened, it hasn't happened. Until it hasn't happened, you might as well learn how to profit from the ups and the downs so you can have more shares at the end of the day.
All right, guys, thank you, and we will see you on the next one.
Take care, Josh.